Hi everybody, my name is Mary Redmond and I'm talking right now about the Euro-New Zealand dollar. So I really like this pair to the downside now, particularly after the New Zealand Central Bank meeting. And the main reason I like this is simply because it has probably the most bearish chart pattern of any other currency pair that I can see out there. It's got a massive multi-year head and shoulders pattern, and which has the potential of breaking the right shoulder and leading the pair to new all-time lows. And just about any time frame and any technical indicator that you're going to look at, it's going to show an extremely bearish pattern which is trending lower, and it doesn't really show any signs of finding a bottom or any real capitulation. So of course this is always due to both technical and fundamental factors. And if you listen to the RBNZ Governor Ballard today, it was, some people say that he was a little bit less hawkish than expected, but the bottom line is the New Zealand economy has been growing quite strongly in 2011 since they cut interest rates following the earthquakes that they had. Their Purchasing Managers Index was a 54.7. Their GDP grew much stronger than expected at 0.8% quarter over quarter. And their rate of inflation is higher than is desirable for the central bank. So there's a question of whether or not the New Zealand Central Bank is going to be raising rates this year. And of course, Governor Ballard did say that there are macroeconomic problems in the global economy, including the debate about the U.S. debt ceiling, as well as the persistent problems with the EU sovereign debt issues. And of course, what happens in either one of those large global economies is going to affect every country. But the basic point is that the Central Bank of New Zealand is going to be one of the few central banks that is expected to raise rates in 2011. And of course, we're going into next week, there's going to be an ECB meeting. And I think it's highly likely that Mr. Trichet may signal that there are going to be fewer interest rate increases from the ECB this year. So this is a very volatile pair. It's difficult to trade because it's often less liquid than some of the other pairs. There's not as many people trading on a day-to-day basis because it's largely institutional traders, whereas with some of the other pairs there are many people constantly buying and selling products from producers and manufacturers both in the EU and the US. So some of the trading that goes on every day is the millions of people that are buying or selling products, but there's just not as many Europeans going to New Zealand every day to change their euros in for New Zealand dollars or vice versa. So that's why it's less liquid and you have to be more careful with the fills. But the other factor, the other reason I like this is there has been a consistent pattern over the last several months. And we have seen every time the volatility index does spike up out of its Bollinger Bands, you generally have a move up in the commodity-based currencies as well as the so-called risk-based currencies. So these particular times here were very good times to buy both the Australian and the New Zealand dollar. And we have also had this big move down in the stock market, and the spike up in the VIX indicates that we should be due for an oversold rally in the stock market over the next few days, and that's generally bullish for the commodity currencies. So of course it's very difficult to trade in this environment because nobody knows how or when the debt ceiling issue is going to be resolved. So there's less liquidity in the market today and these days, primarily because a lot of the big institutions and funds may just be staying out of the market until this is resolved. And people really don't want to get caught one way or another if either extremely good news or extremely bad news comes out. But fundamentally, it would take a lot to change this trend. I mean, if we were going to see a change in this trend, we would have to see probably a real downturn in the outlook for the New Zealand economy and the outlook from the RBNZ, as well as a intermediate term resolution for the problems that are facing the EU. And there's really not going to be a quick panacea for the sovereign debt issues in the EU. It's probably going to be something that's many countries are going to require continued bailouts for a period of time. So this is something that we'll probably be revisiting and hearing more about in the coming months. So I do like this to the short side, shorted from the 65-25 area. And I think that this has an open objective at the present time, and put a fairly wide stop in above 67, because you would really need to see a strong breakout of its downward trending channel before the pattern would actually change for this particular pair. So in this very difficult environment, when we're constantly hearing from government officials all day long, and there's a constant worry about the increase in the debt ceiling, whether or not it's going to happen on time, I think this is a pair that offers a good opportunity for reward that is shielded to some degree from the U.S. debt ceiling issues.